Hi, thanks for visiting my YouTube channel. In this video, we're going to take a look at the role of a placement agent in institutional real estate fundraising. And it's basically two parts to this video. One is to talk a little bit about the advantage that you have if you use one, especially when reaching out to limited partners. And secondly, I'm going to show you some detailed research that I performed regarding placement agents and funds. This video highlights the benefits of using a placement agent for real estate fundraising. So how limited partners process inbound fund opportunities. Basically, limited partners get hundreds to thousands of emails every single month for people that are trying to promote their funds or other investment opportunities. So the typical limited partner inbound funnel will look like this. Initial screening, if it's just general partner direct outreach, in other words, not using a placement agent, it's ad hoc and consistent. Whereas if you use a placement agent, the outreach is very structured and prioritized. Prioritized very much for the reason as reputation. Number two, the credibility signal is really dependent on the general partner brand. If they're doing a direct outreach, again, it's easier to raise funds on the second time around. The very first time is very, very challenging. Obviously, you haven't gained a reputation at that point. Now, secondly, the placement agent outreach, it's inherited from the placement agent reputation, so it gets a lot easier in that case. The stage internal routing, for example, if it's a direct GP outreach, it's often lost or delayed. Remember, if you're sitting on the limited partner side or on an investor side, you're getting hundreds of emails in. So the prioritization, you've already probably got something built into your company to do that. Whereas if it's a placement agent that is sending the investment opportunity, it's routed to the correct investment team. So there'll be parts of that investment team whose core job is to handle placement agency requests. So it's quite a bit different. And then the response probability, well, most of you who have known this and done fundraising, you know that when you start to do your outreach directly, it's very low to moderate. Whereas if a placement agent is doing the outreach, those shifts over to the moderate to high. So one, this reduces limited partner cognitive and operational load. The trusted filtering function. So limited partners implicitly rely on placement agencies as external triage partners. So from the LP's perspective, is if this uh, placement agent is willing to put their name behind the fund, it's least worth an initial review. So that's really the key part of the whole process. Is it's the sender, not the message, many times. Now, this does not guarantee a meeting, but it materially improves first engagement odds. So a bit of comparative response dynamics. So the response behavior observed in market practice, when we look at factors such as an open rate, if it's a GP direct email, it's lower, placement agent email higher. Again, very much like the first slide. Time to response, slower for GPs, faster for placement agents. Again, it's just a different mindset. Remember, it's not the message in the email, it's the sender. Meeting conversion, very selective if it's GP direct email. It's higher if it's a placement agent. And follow-up efficiency is generally GP driven, whereas the placement agent email, it's going to be coordinated to them. So important distinction, limited partners are not outsourcing decision making to placement agents. They're outsourcing filtering and coordination. So it's a key aspect. Remember, you're getting 100 emails a day. You're going to have to take a look at them. And I've known this in other aspects when I've helped people with pitch decks and strategy, is that your pitch deck presentation should be 2 minutes and 50 seconds at maximum, because the person that reads that particular investment presentation, which is what a pitch deck is, they're going to make the decision in about 30 seconds whether they turn it to the next page. And I've done that. I've received hundreds and hundreds of presentations, and I know that I very rarely will get past about the third page. Now, there's also institutional risk management considerations. Limited partners face reputational and fiduciary risk engaging with a placement agent introduces one intermediary who understands LP compliance norms, a buffer against poorly planned managers. Remember, there's a lot of investment opportunities out there that are fantastic, but it could be the manager that's promoting it that's not necessarily as organized as they have. I've worked with groups that have had very, very poor due diligence rooms. And those are key things that have to be remembered. That's the whole package, not just the investment presentation. And the third one is a professional interface aligned with institutional pacing. I always like to say that really that these groups are really what they're trying to do is institutionalize your package. Because that's the type of client that they're generally going to be reaching out to. Now, for smaller or emerging GPs, this risk mitigation is especially valuable. Now, where direct GP outreach can still be effective, so this is the other side of the table, direct GP outreach performs well, one, when they have an existing relationship. Remember, if they've already raised funds, they've probably already gone through this before, they may have used a placement agent, but the odds are if they used a placement agent, they don't have the contacts that the placement agent had, except for probably the contacts that had meetings with, but there's also a lot of times some survivor clauses in there that don't really allow you to go after them. Now, also the GP is an established platform with brand recognition. It's an important one because everybody thinks that they have established brand recognition, but most don't. So it's really important that that person that's evaluating you should be able to tell you that. That's not something you're going to be able to say too definitively unless you've been in the market for a very, very long time and you can prove it. And the LP is previously invested with the manager, so that's key. That's another factor. And the fund is a continuation or successor vehicle. Now, one thing that should be remembered that sometimes this is a very, I guess it could be a thought process where if you've already been successful, sometimes that's the best reason to go out to a placement agent. In other words, you've already done the first fund. Now, if you really want to scale, that's when you bring the PA in, because then the PA can say, look, they've already done this. Now we're on the second fund. So that could be a reason why a direct outreach by a GP could still be effective, or it could be the reason why you want to go to a PA. Now, in these cases, the PA adds less marginal value for initial access. Now, situations where a placement agent has clear advantage. Well, placement agents marginally outperform GP direct outreach when the GP is raising a first or second institutional fund. The fund is targeting new geographies. I'm actually working with clients that want to reach out to Middle East and Asia, based in the USA in most cases, got very established relationships there, but when it comes to going to Asia and Middle East, a lot of times you're going to need a little bit of help to do that, especially if it's your first time. If the strategy is niche or complex, that's when you're going to need a PA to get involved. Or if the GP is engaging pension funds, insurers, or sovereigns, now these types often prefer intermediate access. I can tell you right now that if I were working for ABC company, had a great institutional opportunity, and I sent that out to 100 pension funds, insurance companies, and then if I had a PA do the same exercise with that same 100, the PA would get significantly better response because of the fact that they're already looking at that PA as a group that's already done the heavy lifting as far as DD. In fact, many PA firms for a fee will assist with DA or DD marketing and other things that are going to institutionalize your group. Okay, now let's take a look at some of the research that I've posted on my website. That's DubaiInvestorsList.com. So now we're on the front page, the home page of the website. You can see I have a number of the databases that I have on offer on here. You can check that out a little bit later. But I'm going right to a research report that I've just completed, and it's placement agents in institutional real estate fundraising. So let's go to that and take a quick look at that. And you can see here, I've posted the entire report on here. And it's basically a data-driven review of real estate funds launched since 2014. So I've looked at 11,900 real estate funds. This is specific to real estate, just to use as a comparison and some of the key metrics. I'm not going to go through the entire report. You can visit the website to do it, but this is the real key slide in the entire thing, and it talks about the fundraising insights. For example, based on a review of 11,900 funds, of which 1,590 disclosed placement use, agent use, strategy adoption. So there's a higher adoption among opportunistic value-added debt cross-border strategies. Remember, I spoke about the cross-border aspect of using a placement agency and why it's important, especially if you're heading out to Asia and the Middle East for the first time. Fundraising timeline. So we take a look at that. Now, the first close within 6 to 12 months in the market, and that's basically a wide range, but if I narrow it right down, it's just a little over 6 months when using a placement agent for your first close. Why is that important? Well, if it's taking you 7, 8, 9 without one, those 3 months can be huge, especially when you're dealing with real estate fundraising. Now, the market rates, as far as the time in the market, is anywhere from 18 to 30. Yes, it's a wide range. But if you really drill it down, if you're using a placement agent, you're usually around 24 months to raise a whole fund. What does that mean in layman's terms? If you're looking to raise $200 million, the 6 month first close, maybe that's 10 or 20 million, and the amount in the market, it might take you 24 months to get to that, to get to a 150, 200 million total. Then you go down to the bottom left, usage rate. So approximately 13% of funds use placement agents. Those are real estate ones. Fund size, most frequently engaged by funds within 100 to $500 million. And you have to ask yourself, why would somebody want to use a placement agent? The answer is really clear. If you're looking to raise 100, $200 million, that's a major commitment to your company. And you may take a look, for example, the cost to do that. And in this particular article, I touch on the fact that the costs could be $50,000, $100,000, $200,000, $300,000 just to engage DD, the full package plus your fees. Now, that may seem outrageous to many people, but if you're looking to raise $200 million, remember, using $200 million is with real estate, you're using a leverage as well. So that allows you, in many cases, to get up to the 500 million, 600 million, sometimes in property, sometimes more, depending on the structure. Your returns just go through the roof when you're looking at that. Remember, you have an option of doing this in-house, but then again, you're going to say, how are you going to do that? Well, you have to have a database. Database could cost you 50, 60,000 for one of the key ones, institutional grade. Then you have to hire somebody, at least one person that's going to do this. You may also have to hire somebody that is the manager to coordinate things. You're talking in many cases for two people. Let's just take a look at doing one. You're talking $80,000 to $100,000 a year to pay that person. If the average fund is in the market for 2 years, you're going to be putting in $200,000 minimum. So you could say, well, we could just hire a placement agent to do the same thing. They've got the contacts, and we can bring somebody in-house, maybe at a more junior level, to support that. So that's the difference. And remember that I think that almost everybody who starts to raise capital, let's say for $100 million, $150 million, they're always going to say, I'm going to try it our way first. So they do that. They hire someone inside. They start to acquire some databases. At about the 6 month, 9 month rate, they're finding out they're getting very, very little traction, and then they have to start engaging and talking to placement agents. And a lot of times that's just the normal transaction. In many cases, you may raise 10, 20 million. I know of a case where a real estate group just refused to do any placement agent or even hire anybody to help them raise $100 million. They were able to raise about 7, 8, $9 million on their own over the course of about 18 months. And that money unfortunately went nowhere, because you can't do anything with that low amount when you're trying to raise money for real estate. And lastly, the agent supports. It primarily supports early validation and fundraising continuity. You can check out the rest of that report just by going to the website. There's a fair bit of information on different metrics that are going to help you. And again, you're going to be able to find that all on the website. Are you looking for global funds and contacts? My verified database has over 24,000 global funds and 400,000 fundraising executives. Coverage across all regions, asset classes, and strategies. It's the most complete global capital tool available. For more information, contact DubaiInvestorsList.com. That's DubaiInvestorsList.com. Please like, share, and subscribe.